Most people think that $500,000 is the moment where you finally get ahead financially. But what actually happens is the old financial rules stop working, new risks start taking shape, and entirely new problems show up that nobody warned you about. At this level, even small missteps can have big financial consequences. What if you make a wrong tax decision or a slightly wrong investment move, or you say yes to the wrong thing for your plan? Those can now affect your future a lot more than you think. And that's why in today's video, we're going to be walking through the 9 ways that everything changes in your retirement savings once you are over that $500,000 mark in your 50s, and how to pivot your strategy so that you stay on track. My name is Joe Bogan. I'm a certified financial planner and the founder of Parkmount Financial Partners. I've helped many of our clients cross this milestone and navigate what comes next. By the end of this video, you're going to understand why $500,000 changes everything about how your money behaves, the new mistakes that could cost you thousands and that a lot of people make at this stage, and how to pivot your plan so that your money actually supports the life that you want next, not the one that you were building in your 30s and 40s. And stick around, because the last 2 shifts are the biggest that impact even multimillionaires and derail a lot of people who thought they were set. So let's get into it. Number 1 is that you're quietly moving into the top 20% of people with retirement savings. This is a big one. When you look at the actual data, you can see in this chart, only about 20% of people in their 50s have over $500,000 saved, and only about 10% cross that $1 million mark. In other words, whether you like it or not, you've quietly moved into the top group. And this is the Pareto principle at work, the same pattern economist Wilfredo Pareto described over 100 years ago when he observed that the top 20% of the population is the minority that controls the majority of the capital. And once you enter into this minority, the leverage shifts in your favor if you make good decisions regarding your capital, but it can cut against you if you make poor decisions too. The next one is probably the most exciting part about reaching and exceeding that $500,000 level, and that's where compounding takes over. Before you are at that $500,000 level, the main engine of growth in your portfolio is often your contributions, your salary deferrals, your extra 401k deposits. But once you hit that $500,000 mark, something important flips. This is where compound interest starts to take over. And I'll explain to you what that means. A modest 6% return at $500,000 is about $30,000 in growth. That's roughly the same amount as someone maxing out their 401k contributions. In other words, even if you never increase your savings again, your money, if invested prudently and thoughtfully, can potentially generate as much or more growth than most people are reasonably contributing. That's both exciting and potentially unsettling. On one hand, it means you might not need to keep your foot as much on the gas with your retirement savings, but on the other hand, the market is now driving more progress than your paycheck is. And when growth matters more than your contributions, every market swing is going to feel a lot bigger, which leads us straight to the next shift. And this is where volatility finally is felt. That's exactly when your decisions are going to matter most. When your portfolio is $50,000, a 10% drop was only a $5,000 swing. Now a 10% drop at over $500,000 may be more than $50,000. The percentages haven't changed at all. The math hasn't changed at all, but the dollar impact hasn't. This is where it can feel personal. This is exactly why investors at this level start to struggle with their investments more emotionally. A drop that used to be just numbers suddenly feels like watching a year's worth of savings disappear in a week. And this is where some of the costliest mistakes can happen, not because the market's changed, but because the meaning of these swings can change. Panic selling after a correction, or going ultra conservative before the market's about to go on a run, or chasing whatever safe product is being advertised the loudest. Emotional decisions in investing is where the real money gets lost. But here's where it could be kind of confusing. Once you hit this $500,000 level, you do need to reassess your portfolio, not just in an emotional reactionary way. If you're far from retirement, you need to determine if you're too conservative too early, that can be potentially damaging. Staying too aggressive too long can also be damaging. So we need to really start thinking about what matters. Consider this about 5 to 7 years before and after retirement, where these new risks are starting to crop up that can affect your whole financial life. This is where sequence of return risk is critical. It says if you have 10% per year, the actual sequence of when those returns happen really matter. You can't control the sequence. So even if you have a bad year and things recover, if it's at the wrong time, it can really derail your retirement. And if you don't have a plan in place to protect your retirement transition and navigate these changing market conditions, that can ultimately lead to falling off track. And that's why it's a moment where proactive portfolio planning is going to become critical to your financial well-being. Managing volatility isn't just about protecting yourself from the swings, it's about protecting your future and the transition into retirement that you've spent decades building up to. A thoughtful plan here can make retirement feel smooth and confident, but a poor plan can lead to years of stress and potentially even falling off track with your goals. The next point is where cost of living becomes destiny. This is where context really matters. Kevin O'Leary, famous shark from Shark Tank and author of the personal finance book, Men, Women, and Money, recently said that $500,000 is about the minimum for someone who wants to put that into investments and do nothing else to earn income and just live off their money. For some people in parts of this country, this might be roughly true, but for others, it's going to be nowhere near enough. If you live in a lower cost area, think like a place where a single person might be able to live off of $30,000 or $40,000 a year. $40,000 might be enough to consider, especially if you have Social Security around the corner. Some form of partial retirement or dialing back work might also make sense, and at least dialing back savings may be on the table. But if you are in a higher cost of living area, maybe with a spouse, or maybe you're even saving for future college tuition expenses or early in a mortgage, this could be a different story. $500,000 is still a big deal and is a place where you might need to pivot your strategy, but it probably doesn't mean that you're done. That's why I say $500,000 isn't the level that answers all your questions. It's the level where it forces you to finally ask the right ones. For some, this milestone might mean I can retire earlier than I thought. For others, it might mean I'm on track. It could mean that you can start enjoying your life a little bit more. The meaning is 100% driven by your cost of living and your plan and not the number itself. The next point is big. You have to understand how capital turns into income. Once you understand your cost of living, there's a second related question, and it's the one that almost nobody knows how to answer intuitively. What does $500,000 actually mean for my life? Most of us are fluent in income-based thinking because that's how we live. With our paycheck, we can answer quickly, can we afford a vacation this year? Can we swing country club membership fees in our budget? Can we handle a new car upgrade and the new car payment? Those are paycheck-based questions, and they're much more intuitive. They're how you've connected your money with your life, your entire adult experience. But retirement savings isn't income, it's capital. And capital doesn't speak the same language as paychecks. There's no built-in translation guide from pile of money to safe spending for the next 30 plus years. In retirement, you suddenly have to become your own pension administrator, responsible for deciding how much you can pull each year from your investment portfolio, balancing safety and growth, making judgment calls about probabilities, volatility, and withdrawal math. And you're expected to do all of that without any formal training in financial assets and portfolio statistics. This is why anxiety often increases for people once they hit that $500,000 level. If you are spending a lot, you might feel fear of running out. If you feel like you might be spending too little, you might have fear of wasting healthy years in your life. It's the first moment where people realize this isn't about saving anymore. It's about translating money into life. And that's a shift from earning to engineering your portfolio to meet your income needs. And it's one of the biggest turning points when it comes to someone's financial life cycle and retirement planning. Good news is there are answers, but the only thing is a lot of the news today has these one-size-fits-all rules that don't fit most people's life. The next point is that you hit the lifestyle pivot window. And I see this with a lot of clients in their early to mid 50s. Kids are older, sometimes they're out of the house, and they're healthy enough to travel, hike, play golf, or just enjoy life. Careers might be stable, their income may be at their peak compared to previously in their life. So 500,000 becomes less about bragging rights and it starts to become about the question, am I on track and do I want to keep living my life like I'm behind? This is what I call the lifestyle pivot window. For some people, the answer is yes. I want to keep pushing hard and retire as early as possible, or maybe keep savings for some other important goal or life circumstance. But for a lot of others, the answer is going to be no. If I am on track with my retirement goals, I don't want to keep pushing hard. Maybe I want to coast a little bit, spend more time with family, and travel while my knees still work and I can still live. Dialing back your savings once you're on track is often the safest way to learn how to spend and enjoy your money, but it requires clarity on your plan and spending aligned to your values, not just spending to spend. The tension here is really between responsibility and savings and actually living your life. And it's one of the most meaningful changes that happens after you reach that $500,000 level. Now, the next point is where a lot of missteps occur, which can leave people stuck for years. And a single blind spot can quietly cost someone thousands or tens of thousands of dollars over their lifetime. But before we get into that, let me quickly say this. If you are listening to this and you're thinking, okay, this kind of sounds like me. I'm around this level. I'm not exactly sure what trade-offs I should be considering to precisely shift my finances. If that's you, check the link out in the description below. For a limited time, we are opening up a retirement readiness quiz. And if you fill it out, we will send you a completely free 5-minute video reviewing your financial numbers and giving you feedback. Now, let's get into the next shift that surprises almost everyone. This is where you become the target. Once your accounts cross a certain threshold, the financial world is going to start to notice. You may get invites in the mail, complimentary steak dinners, or you may have advertisements about market crash survival seminars, exclusive alternative investment pitches, complex insurance solutions, shiny new products. Now, not all of these are going to be bad. Some of them, definitely not all of them, could be appropriate tools. The problem is when you start to view these things as emotional painkillers, and people often make them simpler than they seem. If you're worried about volatility, this product will protect you. If you're scared about the next market crash, this strategy is going to guarantee you X. I've got some tough love for you. There is no free lunch in the investment world. If you see normal market volatility as a problem that needs to be eliminated instead of a feature that needs to be managed, you become the ideal target for some of these expensive solutions. At $500,000 and above, the stakes get higher. The fees could matter more. The complexity can hide risk, and opportunity cost starts to show up as potential 6-figure differences in financial outcomes over time. The impact here is simple. You have to understand the fundamentals and really connect with them. Otherwise, someone else's narrative is going to fill that gap for you, usually at your expense, and it could cost you big. Next is taxes are going to turn into a potentially 6-figure lifetime problem. Once you hit 500,000, 600,000, or $1 million, especially if most of it's in pre-tax 401ks or retirement accounts, your future tax bill becomes a significant planning issue. Over your lifetime, the government is going to collect 6 figures, sometimes multiple 6 figures from those accounts through required distributions, ordinary income tax on your withdrawals, and how those withdrawals interact with other things like Social Security, Medicare, and capital gains. This is a stage where you want to start looking at things like Roth conversion. Does it make sense to prepay some taxes at lower tax brackets, or Roth 401k contributions, or backdoor Roth strategies? You could also consider capital gain and loss harvesting and tax diversification, not just asset diversification. One well-timed Roth conversion in your 50s or early 60s might not feel like a huge move in that 1 year, but that move is going to play out over many years ahead. And over time, it can save you tens of thousands of dollars throughout your retirement as that money grows tax-free and comes out completely tax-free as well. The key idea is here, at this level, taxes become a threat, but you control a lot of the levers as to how much you will pay. But you're only going to take advantage of that if you're actually planning and running projections and looking out 10, 20, or 30 years. The last one is where complexity of your financial situation really explodes here. Earlier in your career, the main financial moves were pretty simple. You enroll in your retirement plan, you pick some funds, you try to save a bit more each year. But once you're over 50, you have over 500,000 $500,000 saved, retirement might be around the corner for you. Now, whether you realize it or not, you're responsible for a lot of decisions that are going to affect your finances. When should you claim Social Security? How will you handle health insurance before Medicare and after Medicare? What about Affordable Care Act subsidies or cliffs? How should you position your accounts and which ones you are going to draw from first? How are you going to position your investments for retirement? What do you do about different pension options? How will required distributions interact with your retirement goals and your income plans? I once had a client very honestly ask me, Joe, I wanted to get on track for retirement, but once I get to retirement, do I need an advisor? I told them, obviously I'm biased. I am your advisor, but let me show you some of the decisions that you're going to have to navigate coming around the corner when we finally get to retirement, where he walks through Social Security timing, tax planning windows, healthcare bridge years, portfolio risk adjustments. And he could see that the hard part wasn't just getting to retirement, it was navigating all the issues as you go through your retirement years. Now, you can absolutely do it yourself and learn all these and more issues on your own if you want to put the time and the energy into it. Many people do that, but we can't ignore the impact as your complexity rises. Ignoring the issues can be a big mistake. A lot of people are getting to that point and they're simply just going to freeze. They don't switch anything. They don't optimize. They don't make conscious choices and trade-offs. And doing nothing becomes its own decision, often not the best one. So if we zoom out, all 9 of these shifts point to one simple reality. Once you hit that level around $500,000 or more and you're 50, the game changes from can I save enough to how do I align the money that I have with the life that I actually want. The math doesn't just get easier once you have a bigger number at $1 million. The stakes just get bigger because every decision, your risk, your withdrawals, your taxes, your timing, now are compounding in both directions. If I just said, I had a client that said, well, I need an advisor once I retire. Well, you don't need one, but you do need a way to start thinking about these issues in a logical way. You need a framework because a number of moving parts are going around at the same time and they are related and affect each other in some ways. And that's why we use something called the life-aligned planning framework. It does some basic things. You start with your lifestyle, you get a sense of what the projected next 30 years should actually look like, and that translates into savings and income year by year up into and through retirement. You're gonna have to then align all the different financial circumstances and investments and risks to your needs and your comfort level. And you're gonna have to review different scenarios like tax planning, so that way you're not giving away money you don't have to. And when you get these pieces together, $500,000 stops being a mystery. It becomes a very powerful tool and a very powerful milestone to reach. Here's the takeaway. You are not at the finish line, but you are at a really important turning point because from here, the decisions that you make about lifestyle, about investing, about taxes, and even about your identity matter more the dollar amount itself. If you want help building this framework that actually aligns your money and your life, I want you to click the link in the description below and take advantage of that completely free mini review video that we will send you if you complete it. But even if you never click that link, I want you to take a quiet hour this weekend, write down what you want to happen over the balance of the next 20 or 30 years, and really take a look at your situation and ask, is your plan aligned with that? Or are you still living like you're behind when you're already ahead? So thanks for watching, and I will see you in the next one.